The end product of this lengthy consolidation process is consolidated financial statements, and the first one we're going to look at is the consolidated statement of financial position. For the P Limited Group at 31 December 20x10. Just want to point out a few items. Your goodwill, you can now see the net goodwill as the 15,000 that originated through Journal 1, and then in Journal 3 we've offset the gain from bargain purchase against that to be left only with the net goodwill in this consolidated financial statements. Please note it could have been a net gain from bargain purchase as well. If your gain from bargain purchase was the larger amount, you'll offset the goodwill against the gain, and then the net gain will be included in your opening retained earnings in the consolidated statement of changes in equity. Your equity section is attributable to the owners of the parent and NCI as two separate headings. Ordinary share capital, only that of the parent, not because it's a recipe, but because we've proven why it's only the share capital of the parent. Please note there's no preference share capital in this SFP because only the subsidiary has preference share capital, and that got eliminated through the at-acquisition consolidation journal entry. For retained earnings, we'll look at the statement of changes in equity. When we now look at your NCI, you will understand this is the closing balance for NCI. And if you look at calculation D, it is really just adding all the consolidation journal entries together that had an effect on NCI. And that proves that principle. You only have a change to NCI when there's a consolidation journal entry. When you work through these calculations on your own, please see how they work. The moment you have a little J1 or J4 or J6 or J7 next to it, it means it comes from the consolidation journal entries. When there's a P or an S next to something, it comes from the separate financial statements. It works like that in your homework questions as well. We'll now look at the consolidated statement of profit and loss for the P Limited Group, and it's for the year ended 31 December 2010. The reason why this is such a shortened and condensed blocky is because that's the way the information was given in the trial balances. Please refer back to example 4.1 for a detailed example of all the line items in the consolidated blocky and the effect of intragroup transactions on those line items. We start with what was given, which is 100% P plus 100% S as profit for the year. Then the only intragroup consolidation journal entry in this example was for the intragroup dividend income that was recognized by P. So that Journal 4 and Journal 5 reference you see there is for that debit leg of the dividend consolidation journal entry to eliminate that dividend income from the profit of the group. There was no other comprehensive income, so profit for the year is equal to other total comprehensive income for the year. Right, but the important part of the consolidated blocky is this section at the bottom where we now attribute that profit of the group to the equity participants. Now you'll follow the same approach. You calculate your non-controlling interest amount and you balance back to what is attributable to the owners of the parent. What's important to note, and the effect of chapter 8 on this section of this blocky, is merely that you have to realize you now have two amounts that you have to add together. Please note that this is an or in between. You can either use the two consolidation journal entries, Journal 7 and Journal 8, to get to these amounts and add them together, because the 36,000 Rand is the profit attributable to NCI ordinary shares, and you add to that profit attributable to NCI preference shares. So you can either use your two journal entries, or you can read these two amounts from the analysis of equity. Same amounts, 36 and 6,000 added together. Now you can understand why there was a journal entry necessary for that 6,000 Rand in the current year, because there's a line item that we present, profit attributable to NCI. As we've said, the profit and total comprehensive income are the same. Your top and bottom portions attributed will be exactly the same as well. The last statement for this example is the consolidated statement of changes in equity of the P Limited Group for the year ended 31 December 2010. Remember, it is a reconciliation of opening to closing balances of all equity items, indicating the detailed movements during the year. We already spoke about the ordinary share capital only being that of the parent. We do not have preference share capital in this example because the parent didn't have any preference share capital, only the subsidiary, and that got eliminated. Now, the effect of Chapter 8 on this statement is that your non-controlling interests very specifically now comprises more amounts that you end up adding together. As an example, your opening balance, that 143,000, calculation F, remember the top portion of the calculations uses the journal entries and the alternative uses the analysis of equity. That 143 will be the 45,000 coming from the at acquisition ordinary shares. The 65,000 comes from the fair value at acquisition preference shares, and there was only 1 cent to opening balance amount coming from the ordinary share analysis and the journal entry you had to write there. Please remember, when it's in brackets J1, J6, J2, it refers to the consolidation journal entries, so that you can see the effect of those consolidation journal entries on the line items. You can also use the analysis of equity, where all 3 amounts can be identified on your 2 analyses. Now, profit for the year attributable to NCI, we've calculated this amount in the consolidated splockie. What you had to pick up from Chapter 8, it's now 2 amounts. It is the 36,000 and the 6,000 added together. Right, now remember something that you had to pick up in previous chapters, and that comes together nicely now, is these debit entries in the NCI column. They relate to the elimination of the dividend declared by the subsidiary, and that debit movement as a second step to the NCI balance. This is now after we've attributed. This is now looking at step 2, where the balance is reduced with the actual dividends declared to NCI. Your closing balance in this column will be what is presented in the consolidated statement of financial position. If you take the totals of your 2 analyses at the end of the reporting period and you add them together, you'll get the same answer. Let's wrap up this consolidated statement of changes in equity by looking at the retained earnings column. Remember, all the amounts presented in the retained earnings column must represent equity attributable to the owners of the parent. So your starting point will always be that of the parent, and add to that the equity of the subsidiary attributable to the owners of the parent. That opening balance of 234,000, let's use the analysis for that amount. You start with 100% of the parent and you add to that 2 amounts coming from the analysis, but remember, there wasn't anything attributed in the preference share analysis for that period since to opening balance. This is where the analysis is so helpful, because you can just read those amounts that you've already attributed to the owners of the parent and add that to the actual amounts coming from the separate TB of the parent. Now, some easy marks. Let's quickly wrap up the dividends. You now know that your dividends should only be that of the parent, not again because we are remembering a little recipe, but we have a principle that we apply to get to those amounts. We add 100% of P to 100% of S, but then there was a consolidation journal entry to eliminate the dividend declared by S, so you are left only with the parent's dividend declared. For calculation I, there was only a preference dividend by S, but that got eliminated as well, so you left with nothing in the retained earnings column. Please note, this is a calculation. There's a principle behind that, but earn those easy marks. Remember, it's only the parent's dividend included. Last one is profit for the year. First item, I just want to do the journal entry first. Here we say 100% P plus 100% S from the separate trial balances. Then we wrote 2 consolidation journal entries to eliminate the dividend income. Included in that 143,000 of the parent is that dividend income recognized from the dividend declared by S. Remember this. Remember to exclude that dividend income from your combined profits. And then the last 2 journal entries, Journal 7 and Journal 8, was the profit attributable to NCI that we've moved out to the NCI balance. This 36 and 6,000 ended up there as the 42,000 profit attributable to NCI. You can also use the analysis of equity. If you use the analysis of equity to calculate the profit of the group, you start with 100% of the profit of the group. You can see now the purpose of the analysis. It helps you to remember about these 2 amounts of dividend income that you again have to eliminate against that profit of the parent. Then you read from the 2 analyses the profit attributable to the owners of the parent, and that gives you the total profit of the group. Something else I want you to notice here is that even for the parent, the preference dividend that was attributed and declared has no effect on this profit of the group, this retained earnings column, because what you have attributed also got declared to them, that 4,000. So it's an in and an out, attributed and declared. And the moment it's declared, it's income that has to eliminate.